Let's talk about the taxation part. So, how are small cases taxed? So, before we get into that, I'll give a very brief about how taxation is done. And there are a lot of very able CAs on Twitter. So, if I go wrong somewhere, please pardon me. I'm not a qualified professional for to give tax advice. Uh, so, the capital gains is basically divided into two parts. One is the short term capital gain, also called STCG, and one is a long term capital gain, it's called LTCG. Now, when you buy a stock and you hold it for a certain period and then sell it off, that period basically determines what type of tax you will pay. So, if you have held a stock for less than 12 months, then you will be paying STCG. If you are holding the stock for more than 12 months, you will pay LTCG. So this is a sort of very basics here. And stocks and mutual funds or basket of stocks or basket of PMS, all these are treated similarly. So stocks and mutual funds, if you are selling in less than 12 months, you'll be paying 15%. If you are going to sell in more than 1 year, then you will be paying 10%. And there are small surcharges on this. F&O taxation is totally different. So if you are doing any F&O, that will go as business income and you will be paying that 30% plus tax on it. So never confuse F&O with long-term capital gain or short-term capital gain. That is not considered in these categories at all. So that is a business income, and you can set off your business losses against that, or take expenses against that, because that is treated as a business. Stocks and mutual funds and PMS etc. can also be treated like a business, but it depends upon how you are declaring it to the income tax department and how the income tax officer is perceiving it. There used to be a very this used to be a very gray area from last couple of decades, that I'm seeing that you can be arbitrarily pulled up for not treating your gains as business income in case your volume is very high and you trade frequently and things of that nature. But in the last few years there has been clarity, and the income tax department says if you are declaring it as capital gain, then we will take it as capital gain, and you stick to that regime. Don't churn from one to the other, from 1 year to the other. Of course, all intraday trading, all non-delivery based any kind of trading, all F&O, all that will go towards either business income or speculative income. So that is totally in a different regime altogether. Within the LTCG, for very small investors, up to rupees 1 lakh, you still have some waiver of the LTCG. But mostly people who are using small cases or some other larger instruments will not fall in that bracket, and above 1 lakh it will be 10%. But you can still have that 10% off on the first lakh on LTCG. So that advantage is there. In terms of the applicability of taxation in case of years of loss, well, let's first take some examples just to simplify things. So 10,000 shares of ITC, if you bought at 200 and you sold in 11 months, let's say you bought on June 21 and you sold in May 22, then STCG will be applicable, and you made 80,000 rupees, so 15% on that, where you will be paying 12,000 tax on it, right? So very simple STCG case. Another case is you bought 20 lakhs worth of ITC on 14 June 21 and you sold after 13 months. So you made and you sold at 208. It moves that much only these days in 1 year, these in the last many years. So you will make a gain or loss of 80,000, and since you are within that bracket of 1 lakh of capital gain, you'll not pay any tax on this. If you have a gain of more than that, let's say 2,50,000, and then the tax applicable will be for the portion above 1 lakh, and you will basically pay 10% on the portion above 1 lakh for 1 lakh 50,000. So you'll pay 15,000 tax, so on and so forth. So very simple way of doing this. Now a lot of people are not paying tax. I know this for sure, that a lot of people are either by not knowing about it, how to pay, or they are lethargic, or they just don't want to pay. So I think the income tax is changing dramatically, and they are able to extract all kinds of data from the exchanges, and a pre-filled capital gains analysis will start coming, I think, from this year onwards, where you will already be presented with what capital gains you've had, and then if they are not correct, then you'll have to correct it. So please all pay your whatever capital gains is due. Now let's look at how small cases work in this way. So let's say you bought a small case worth 2 lakhs on 1st May, right? And let's say 10 or 11 months later, you have 30% returns on the overall small case. Now the point to note is that your small case purchase, and let's say in 11 months or 13 months you sell off the small case. The small case itself is not the taxable entity or the instrument. So you bought here and 13 months later you sold there with several rebalances on the way. So this entity is not getting taxed. What is getting taxed are individual stocks that are getting transacted. So if you bought a small case and there was a churn in it, then the buying and selling of the small case has no relevance. You have to see each and every stock, whether that stock purchased or sold is getting under the purview of short-term capital gain or long-term capital gain, and you'll have to do that individually. So you, like in this case example that we've given, so this 2.6 lakh gain, or sorry, the 60,000 gain could have been made up of 80,000 gains from some stocks and 20,000 losses from another stock or a few stocks. So on some stocks you will attract short-term capital gain, and then you'll be able to net it off versus the losses that you have. So you'll need to do this, and this will need to be done on a first in first out basis. So in case you were holding some stocks from before you bought the small case, let's say you were holding Reliance and your small case now bought Reliance this year, and you were holding it, let's say, from 3 years ago in the same demat account. Now you've sold, let's say, after 3 months, the small case one. Then from a tax point of view, your original Reliance is what will be considered to be sold at that point. And you'll either get long-term capital gains on that, or if in case you were going to hold it for a very long time, then you've sort of ruined your tax regime on that. So ideally, use a different small case DP, depository account, in case you have long-term stocks that you don't want to have any tax implications on because of your small case operations. So have separate demat accounts. But in case you don't want to, and you want to use the same demat account, that is fine as well. I mean, there's no issue in that. Now another thing to note is that not all years will be profitable. So you may have a year where you are 20% down. So what happens in that case? So you again calculate your short-term capital loss, and you can carry it forward. So short-term capital loss can also be carried forward for 8 years. So in the next year, next financial year, or the next financial year after that, in case you get gains at that point of time, you can set it off against it. So short-term capital gain, you can set it off against short-term capital gains. Long-term capital gains, you can set off against long-term capital loss. So short-term versus short-term, long-term versus long-term. In addition to this, I also wanted to touch upon how to calculate your, these profits and losses. So there are several softwares available in the market. Most of the brokers also may provide you with a capital gain report, but a lot of times I've seen broker reports are not so accurate because adjusting for splits, adjusting for bonuses, adjusting for any rights, etc. That capability is not there with most brokers. So some may provide some premium services, like Zerodha has some premium service, and then there are other commercial softwares which are available in the market. If you're a larger investor, then you can spend 3, 4, 5,000 rupees a year on a good software like this, and have an accurate STCG, LTCG differentiated calculation, so that tomorrow, if in case there is a ITO query, you are able to present that report to them also without a problem. So this is I think mostly what I had to say about taxation. It's a very simple subject, and 15% tax is very, very reasonable. Another thing that I wanted to add here, right, was that you can compare the taxation of the small case versus the mutual funds if you are having. So if you are, let's say, you are having comparing them both over, let's say, 2 or 3 years. So on mutual funds, you can say that if average maybe like 12% return if you got, then you'll be paying 10% on it. So about 10.8% will be your post-tax CAGR on your mutual fund returns. And if you are able to get after fees and other costs, let's say 15% in a small case, and you'll be paying 15% on that gain. So your net post-tax will be 15 minus 2.25, so 12.75% will be your post-tax gain in that situation. So you can always compare like this, what is my cost, post-tax cost for doing mutual funds, and what is my expected return from small case, and minus what is my fee as a percentage of my capital, and 15% tax on that. And this is what the sort of the comparison could be between the two. The only difference here being that the cost of transaction on small cases is more or less covered by the dividends that you receive on it also. So that's why I'm not including the cost of transaction there, because in my experience it is more than covered by the dividends in case you are doing mid cap and large cap companies mostly. Small cases, if you are doing, then the returns are much higher. So there is really no comparison that gets left in this. So this is all I had on the taxation issue. If you have more queries, do send me mail or put it in the comments, and we'll try to answer there. Thank you so much for watching, and I'll see you in another video. Bye.